Okay, let's unpack this. We're diving deep into Swiggy Limited's unaudited, consolidated financials. This is for the quarter and the half year ending September 30, 2025. So Q2 FY26. Now, these reports, they can be pretty dense, right? Full of jargon. Our goal today, really, is to cut through all that complexity. We want to understand the real story here. What's happening with growth, profitability, and their future strategy based on these numbers.
Exactly. And if you just kind of look at the top line, the story is really about scaling up while tightening the belt, finding those efficiencies. So to give you some anchors, remember, these are in Indian rupees, crores, so significant market activity here. The two big headlines jump right out. First, platform gross order value, the GOV, it shot up 48% year over year. That hit INR 16,683 crores.
Wow, okay, 48% year-on-year growth is, well, that's really aggressive. But
Yeah.
in this market, growth alone isn't enough. It needs that path to actually making money, right?
Yeah.
To the black.
It did improve, yeah.
Yeah.
They consolidated adjusted EBITDA loss. It got better by INR 118 crores just from the previous quarter. Now look, it's still a loss. INR 695 crores for the quarter. But that sequential improvement, that quarter-over-quarter change, that's the key signal. It suggests the strategy is, starting to work. The path to overall profit looks like it's speeding up.
Right. So our focus for this deep dive is basically threefold. We'll look at the core food delivery business that seems to be the profit engine, then how that engine is actually funding the big push into quick commerce with Instamart, and finally, these big strategic money moves they're making. A major divestment and potentially raising more funds, building that war chest. Okay, let's start with that funding source, food delivery. The reports make it pretty clear this is where the profit's coming from right now. What are the key numbers showing that?
Well, the food delivery GOV, it grew 18.8% year over year. That's INR 8,542 crores. But the profitability growth, that's where it gets really interesting. Adjusted EBITDA, it improved 2.1 times compared to last year, reached INR 240 crores this quarter. And that pushes their adjusted EBITDA margin to 2.8% of GOV, which is 44 basis points better than just the last quarter.
2.8% margin.
Yeah.
That improvement's impressive, especially when, like you mentioned, management's saying the order growth, that double-digit UOA growth, was the highest they've seen in 2 whole years. So this part of the business, it isn't just coasting, it's actually accelerating while getting more efficient.
And a lot of that comes down to users and how they're pricing things. Average monthly transacting users, MTUs, they grew 17.2% year on year. About 17.2 million users now. And strategically, they're really leaning into affordability and convenience. You see it with things like Bolt. They're super fast, like 10-minute food delivery. That's already more than 1 in 10 orders. And also the 99 store initiative for, cheaper meal options.
Yeah, that 99 store focus, it kind of shows that even the profitable part needs to fight for that budget end of the market now. It's strategic, not just, random growth. But what about the cost to the user? Management mentioned the total cost delivery fee, platform fee. Membership stayed around 5–6% of the average order value.
Right, so they're trying to make money without driving customers away with big fee hikes. Seems stable for the last 3 years, they said. But here's something really interesting tucked away in the details. The money they make from advertising and other platform monetization. It actually brings in more than the entire adjusted EBITDA margin for the food business itself.
Wait, say that again? Advertising revenue is more than the profit margin. Doesn't that sort of raise a flag about the actual food delivery transaction? Like, is the core delivery part viable on its own? Or is it more like an advertising platform that just happens to use food delivery?
Well, it definitely shows how much they rely on that whole ecosystem,
Yeah.
Platform fees, ads, memberships. It's not just the commission on the food. That's pretty common for big platforms, sure. But it does highlight a potential vulnerability. What if ad spending drops? Or people push back against platform fees?
Interesting point. And speaking of different models, they launched Tuing in Pune, a totally separate app, right?
Yeah.
Testing a marketplace for low AOV budget users. Management admitted the economics for those really cheap meals are tough. So is Tuing a real bet on market share or more like a defensive move, protecting against maybe cheaper niche delivery services popping up?
I think it's probably a bit of both, honestly. Market expansion and defense. By keeping it separate, they don't dilute their main brand, the higher margin business, but they still get to experiment and try to capture that huge group of, students, people starting jobs who are super price sensitive. It's a calculated risk, trying to unlock that segment without messing up their main thing.
Okay, so that food delivery engine, making profit, is clearly set up to fuel something bigger. Which brings us squarely to Instamart, quick commerce. the hyper-growth area. This is where the big money's going, and crucially, where we're finally starting to see some real efficiency gains pay off.
Oh yeah, the growth there is just, well, explosive. Instamart's GOV, 108% year-over-year growth. And it accelerated even quarter on quarter, up 24.2%. That's INR 7,022 crores. They've got 12 million monthly users now on Instamart. So, yeah, the sources definitely confirm it's moving incredibly fast, needs a ton of capital. But the discipline on the operations side is actually quite impressive.
That's the fascinating part, isn't it? Improving margins while growing that fast, usually those two things pull in opposite directions.
Exactly. But here, contribution margin improved significantly. 202 basis points better just quarter on quarter. It's still negative, mind you, at negative 2.6%. But the adjusted EBITDA loss also shrank, down to INR 849 crores from 896 in Q1. And management sounds pretty confident they're guiding for contribution margin break-even before the June 2026 quarter, so within a year or so.
Breaking even on contribution margin that soon would be huge. I see two main reasons driving that efficiency.
Yep.
First, the average order value. It grew almost 40% year over year, hitting INR 697. Just making each delivery stop worth more money. That's a massive efficiency lever.
Definitely. And the second big driver is the product mix, what people are actually buying. Non-grocery items, general merchandise, that stuff now makes up 26.2% of the GRV. That's way up from just 8.7% a year ago. And those categories just have inherently better margins than, say, milk and bread.
Going from 8.7% to over 26% non-grocery in a year that's a monumental shift.
Yeah.
But can they keep that up? Does that mean competing head-on with Amazon, Flipkart, other specialized retailers? Or was that big Quick India Movement sale event they ran just a temporary bump, make the non-grocery numbers look good for the report?
Well, management talked about that shift directly. They said QIM, the sale event, was specifically designed to reposition Instamart in people's minds, not just groceries, but in everything store. And they pointed out that non-grocery stuff, like electronics, small appliances, it's doubled in the mix over the last 2 quarters. So they argue it's structural, it's driven by getting higher spending customers on board, and it's absolutely key to their plan for better margins going forward.
Okay, structural shift, got it. Let's talk physical stores then, or dark stores. Despite that triple-digit GOV growth, they only added 40 new dark stores in the quarter. Total's now 1,102. That feels, well, slow. Almost cautious compared to how fast the orders are growing.
And that slow pace, that's deliberate. It's a really crucial strategic change. Management basically said their current dark store network is underutilized. It can handle more than double the orders they're doing now. So the focus isn't on just planting flags everywhere anymore. It's about increasing throughput, getting more orders out of each existing dark store per day. That metric went up 4% quarter on quarter to 825 orders per dark store per day.
Right. That focus on throughput, up 4% QOQ. That's the real headline there, isn't it? It's not just about saving money. It's like they're saying, okay, the really expensive part of building out quick commerce, the physical infrastructure, is mostly done. They're shifting from grabbing land to making the assets they already have work harder. Capital efficiency. That changes their risk profile quite a bit, makes them look more disciplined.
Absolutely. And the customer data seems to back that up. The group of users they acquired just this last quarter, Q2 FY26, they're already spending 1.61 times what the users from Q4 FY24 spent in their first quarter. So they're getting better customers who stick around longer and spend more, especially on that wider range of products.
Okay, before we get to the big money moves, let's just quickly touch on the out-of-home segment. Dine out, stepping out. Seems like a quiet win.
Yeah, it's humming along nicely. Not the main event, but steady progress. GOV for that segment grew 52% year over year, hit INR 11,118 crores. And importantly, it actually turned profitable on an adjusted EBITDA basis. Small margin, 0.5% of GOV, but positive is positive. Every bit helps fund the bigger plays.
Adds to the pot. Okay, now for the capital strategy. This really signals their future plans, I think. Let's look at their cash on hand and what they're planning to add.
Right. So as of the end of September 2025, they had INR 4,605 crores in cash and equivalents. Decent cushion. But the bank account's about to get a lot bigger. They've signed the papers to sell their entire minority stake in Rapido, the bike taxi company. That sale is expected to bring in INR 2,399 crores, pending approvals, of course.
Okay, so that Rapido sale alone adds nearly INR 2,400 crores. That gets them to a minimum reserve of roughly INR 7,000 crores just from cash and that divestment. But sounds like the board wants even more firepower, more flexibility.
They certainly do. The board's meeting, I think, November 7th. To consider raising up to another INR 10,000 crores. This would be through a QIP, a qualified institutional placement, the reason they gave. securing growth capital, and enhancing strategic flexibility because competition is still fierce, lots of investment happening in the sector. Look, raising that much money, potentially up to 10,000 crores, that's not just about covering current burn rate. It signals something bigger. Either they're bracing for a major international player to really make a push into India, or maybe they're getting ready for an IPO and want to look incredibly strong financially. A huge cash pile reassures investors.
Yeah, it feels like a power move, making sure they have the cash to call the shots in the market for the next few years, no matter what the economy does.
Yeah.
Before we wrap up with the final takeaway, we should probably mention their sustainability goals, too. It's part of the operational picture.
Yes, good point. It's not just spreadsheets. It's about the real-world operations, too. They're expanding their network for EV partners, electric vehicles. The goal is a 100% EV fleet by 2030. They've apparently expanded the EV fleet 7 times just in the last year, and they estimate that's helped cut over 4,500 tons of carbon emissions. So it's good for the environment, likely helps with compliance, and maybe even lower fuel costs down the road.
Okay, so pulling all these threads together, the profitable food delivery, the disciplined but explosive growth in Instamart, and this huge amount of cash coming in.
Wow.
What's the overall story here? What's the narrative?
I think the narrative is one of, let's say, mature aggression. Does that make sense? Food delivery is solidly profitable, and it's successfully bankrolling the big push into Instamart. And in Instamart, the unit economics are getting much better, fast, thanks to higher order values and that crucial shift to selling more than just groceries. Operationally, they seem to have a good grip on the core businesses, and strategically, they're building this massive war chest selling Rapido, possibly raising another 10,000 crores to cement their market position. Ready for whatever comes next, be it tougher competition or maybe even an IPO. They look well-funded and focused.
Yeah, mature aggression. I like that. It fits. You're looking at a company that's used its strength in one area to successfully de-risk its big bet in another. And now it's gearing up to really consolidate power. So given that combination, strong operational control, that long-term EV fleet goal showing operational planning, and this massive impending cash injection, here's the final thought for you, the listener, to chew on. What does a strategic reserve that could easily top INR 17,000 crores allow Swiggy to do next? What do they disrupt? They clearly have the money, the delivery network, the tech. Is the next big move just doubling down on food and groceries? Or are they prepping a leapfrog move into completely new adjacent digital services? Where does that kind of money take them beyond the current battles?